bright future. We're talking real money.
Wait a second. Tom is back from vacation?
Only temporarily.
I thought you were still on vacation.
I'm hoping.
Yeah, hope springs eternal. Hey, it's like it's been a long time since we've been together, although we were technically together last week on Saturday doing the show with you, except we weren't really here. Our voices were here, but were we? No, we weren't here. You were gone. You were in Hawaii.
And I heard the beginning, and it sounded like we were really here. So
yeah,
that's all
it was magic.
Of course.
It was magic. It was probably for the best because guess what? I caught the stupid holiday virus.
Yeah, you sounded bad there for a few days.
It is so typical. No wonder I'm Scrooge-like. If you get out among people, they give you things.
When you're
not
hermit-like,
presents.
you don't really suffer.
Not presents either. Bad things.
You should celebrate Christmas in the way you want. We'll celebrate it the way we want.
Yeah. That sounds like a version of
Dickinsonian
thing. Yeah. Hi, everybody. Welcome to Talking Real Money, the radio show that becomes a podcast. I am Don McDonald in improving health. That is Tom Cock, recently sunburned in Hawaii. And we're glad you're there to join us here in 2026 as we try to help you make money, make more sense on Talking Real Money. Our phone number is 855-935-TALK. That's 855-935-8255. Now, we are big believers, and it's not because we're simple, but we believe in simplicity. Simple people.
You read some of the comments sometimes.
Maybe.
You get that, so
yeah,
okay.
Simple people like simple solutions, and we don't think that investing and managing money and doing all the things you need to do for your future need to be all that complex. So to start the new year off on another right foot, we're going to right, then go left. We want to share some ideas from the good folks at Morningstar on how you can decomplicate your portfolio.
Yeah, parts of this I really like, and parts I struggle a little bit. I struggle with the headline is 3 ways to simplify your investment portfolio in 2026. The subheadline, here's how to reduce complexity in your portfolio without sacrificing returns. Now, you don't know that. They don't know that.
They don't know that.
Nobody knows that.
Apparently, they don't have a compliance department poking their nose in, saying, you can't say that you're not going to, or that you are going to make more money, or you're not going to make more.
Nobody knows that.
You just talk the rest of the show. My wife said you should just talk the whole show, so maybe you should.
That would be a first. There's a few things I really do like about this. And by the way, they quote Christine Benz, who will be at Morningstar. She'll be at Morningstar, but she'll also be at Retire Meet here in, that's like less than 2 months from now, right? Or something.
She'll be at Morningstar 51 weeks of the year and Retire Meet for a couple of days.
There you go. She says clutter in your financial life, like clutter on your desk, has the potential to distract you from the main jobs at hand. And in her mind, you might not be reviewing and maintaining your portfolio if it has too many working parts. So here are the few things they recommend. I really do like these. Number 1, swap your actively managed funds for index funds.
Can I just give Christine a little lesson?
Please don't.
Would you stop promoting them then at Morningstar? I mean, they say this.
Later in the article, they even promote them again.
Yeah, they say this, and then you go, and our 5-star rated funds are active. It's we're all a little bit hypocritical, aren't we?
Yeah. Mm-hmm. But that is we think that's sage advice anytime. It doesn't have to be beginning of the year, and doesn't have to be just to clean up your portfolio.
No, I was just using the beginning of the year as an excuse.
No, I think it's a good excuse. Here's another one. Favor broad all market stock funds instead of multiple style specific equity products. Now, what she's talking about here is just owning one fund, for example, a total stock fund, a total bond fund, rather than owning a fund with the S&P 500 and U.S. small cap value, an international large, an international small, all that kind of thing. Because it's pretty hard to manage that. Although we got a guy who wrote us today who said he uses Paul Merriman's 10 fund strategy. I run into a few people, but not many who do that.
We sort of kind of promoted that back in the day until we went, nobody's going to do this. I mean, unless you're very data oriented, and unless you're
it's hard.
Unless
you're
Paul's audience, like the engineers.
Yeah. It's hard work, and it's complicated, and it's counterintuitive many times. So, for example, at the end of recently past 2025, you've been selling things like international small cap value that made 40+%, and momentum funds that made a lot. So you'd be having to sell those and buy the things that didn't do as well. People struggle with that.
Yeah,
I've seen that many times. Hard to do. And then another one that for do-it-yourselfers, we have said many times, delegate some or all of your asset allocation to a target date or allocation fund. Target date fund, of course, would be one that I guess could be reflects the year you're going to retire. We'll talk about that later. And adjust the stock to bond ratio accordingly, right? So you have a certain amount in risky things, less in less risky things, those kind of things.
It's funny. I just did that with my 401k.
You just rebalanced?
I just rebalanced to a target fund.
So you're all in, because I'm mostly in the dimensional target date fund, but then I think I added more small cap value.
No, I'm going straight with the target fund. I think it was 2035, and I just went with that.
Oh, is that the year now? Can we count on that?
No. I just picked that year because it's a little bit more stock oriented. That's all.
I was thinking that was going to be the end with this cold. I thought that was it anyway.
2035. I probably won't last that long. The way I'm going. Hey, give us a call if you've got a question about money, how you can manage it better and have more of it. 855-935-TALK. It's easy. It's free.
Tom and Don are talking real money.
AI is incredible. It can teach you how to fry an egg and even write a poem, pirate style. Yarr! But it knows nothing about your work. Slackbot is different. It doesn't just know the facts. It knows your schedule. It can turn a brainstorm into a brief. And it doesn't need to be taught. Because Slackbot isn't just another AI. It's AI that knows your work as well as you do. Visit slack.com/meet Slackbot to learn more.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Tom, Cock, Don McDonald, and we're going to get to the phones in just a minute, but I want to kind of close the book on simplifying your portfolio. Now, Hodgepodge-itis is something that Don has talked about for, like a decade. Getting over having numerous accounts, numerous places, etc. This article really is more about having fewer funds. And as I said at the beginning, I hate the promise they make you about not sacrificing returns. Here's the part we don't know. It may be that one fund solutions do every bit as well as owning 10 funds. We don't know that. I mean, and we don't know, by the way, if factor investing is going to necessarily do better than just indexing. None of those things.
We don't know anything. I'm back.
So, yeah, you were gone for a moment. So the thing is, don't accept that promise, but know yourself, I guess is what I would say. Because if you're going to try to manage this on your own, I like the 1 or 2 or 3 fund portfolio. That makes sense for you.
I do too.
If you're going to have somebody else do it, then they should probably be doing some work. They should probably be selling stuff and buying. Not every day, but over time.
Because the reason is, and we generally recommend that someone else do it for you as your portfolio gets bigger and more complicated, because life gets bigger and more complicated, and because those fractions of a percent that we believe might happen based on past data are much more significant on larger sums of money.
And it's hard, by the way, because there's another article we looked at for the weekend that Jason Zweig just penned, to be a factor investor, because you have to have a lot of patience and you have to have a lot of discipline. It's really hard to do that many times on your own. Not saying you can't, but it's harder than just buying an index. I'll put it that way.
And if you have questions on how you can do this right, give us a call at 855-935-TALK, 855-935-8255. Let's head to Bellingham, Washington. Joel, welcome to the show.
Hi, thanks for taking my call. Look forward to hopefully seeing you guys at retirement here in a couple months. I've got a question, speaking of simplicity. I've got a young child, actually an 8-year-old, and we started a Roth IRA for him very carefully with the advice of our CPA and a little self-employment business that he runs. And currently all of that Roth IRA is 100% in AVGE. And I heard you guys talking probably a few weeks ago about AVGV, which appears to have an even more value tilt and a broader international bias or more international. I'm just considering putting 100% of that into AVGV, given that he's 8 years old and he's got a long time horizon ahead. And I just like your thoughts on that.
Yeah, I hope he has that's awesome. But I got to ask before we even get to that, what is the self-employment that the 8-year-old is doing? Not that we're with the IRS or anything, but I'm just kind of curious.
I shoveled driveways at 8.
Did you?
Yeah.
Okay.
Yeah. He's
got
storage lockers that he rents out. So it's just, you picture old gym lockers, and in our community here, there's a need for that. And so he rents out these gym lockers, basically to store up on the border here. If travelers are going across the U.S. carrying a firearm with them, they can't take it to Canada. So I help him, obviously, but he's got these storage lockers, and people can lock them up safely. And his job is to clean the locker, do the paperwork.
Wow.
Your kid has access to guns? Okay, I'm worried now.
No access.
No, I'm kidding.
Neither do we.
Yeah.
That's great. Yeah,
they lock them up. We don't get access to them, but we clean the locker and fill out the form. And
that's really terrific. Yeah, my grandsons of a similar age should probably be locked in that locker rather than renting it out. So that's a whole other thing.
Yeah, I've seen them in action. Yes, that would I can.
So what you're really asking is, should you have a greater value tilt, if you will, than AVGE? AVGE is the Avantis Global Equity Fund, which has a tilt. And we want to be careful when we say that. What we're saying is, if you just bought the index, you end up with a lot more large bias. A lot more bigger companies take up more of your money. When you buy AVGE, they purposely buy more of those smaller and value companies than you would get in the index.
AVGV, though, has two...
I was going to go to that, yes.
It has two wonderful things. It's not just the value tilt. From my perspective, it is a much heavier international.
To what are the percentages?
40% basically, non-U.S. equities, to 31.
In which one?
AVGV.
AVGE has 31% international.
Right. AVGV...
GV is in victory.
Is almost 40.
Which you like.
Which I
Don
love.
would prefer to be half. Yeah. I mean, and so you're making a bet in a way that the future will look like it did in 2025, in 2000, et cetera, et cetera. So, yeah. So what would I do if I was starting today? Wow. I hate to say it because I know we're going to get people saying, should I switch? I'd probably go with the newer fund because I'd rather be more international.
Here's the thing about AVGV. It has a greater value tilt. It has a greater small cap tilt, pretty significant, and a greater overseas tilt. And for an 8-year-old, particularly if this is money for retirement,
that's so amazing.
Tilt away, laddie.
Yeah.
Awesome. Hey, real quick, part 2 to that. How about for a 38-year-old? How about for dad?
Same darn thing. If it's
I wouldn't change it. I mean,
AVGE and
yeah, no. Again, I would stay with that same fund, the newer AVGV, for the previously stated reasons. We really want you to have exposure to a global portfolio. The 40% more accurately reflects what the globe looks like now in terms of stock values inside the United States and stock values outside. So, I'd probably take that one.
But, and bear in mind, Avantis is not trying to look like the global market. They're trying to look like their factor tilts that we talked about earlier. Mm-hmm. So, I really do like AVGV. I'm trying not to confuse people.
And that's what's going to happen now. All these people are going to rise and say,
I know.
You told me AVG, I'm going to sell that.
And then
there's not going to be that much difference.
Then somebody else is going to look at it and go, AVGV doesn't have as much history. Well, no, it's newer. But yeah, go more aggressive. What the heck? 855-935-TALK is our number. Call us.
Tom and Don are talking real money.
Nova Scotia, Canada is a global leader in renewable energy, including green hydrogen, offshore wind, and tidal power. Learn how you can be part of it at investnovascotia.ca.
For your real life and real future, Tom and Don are talking real money.
Now, I hate to talk about returns, but I want to use these returns as an illustration. This is a very interesting illustration of the difference between the Avantis all equity markets, AVGE, and the Avantis All Equity Markets Value, AVGV, exchange-traded funds. In 2024, the AVGE fund, the less value-oriented fund, returned about 14% for the year from Morningstar.
Yeah.
AVGV, the value fund, just a little over 11. Did a lot worse.
Now you're saying this is 2025?
2024.
2024. Okay.
Now 2025.
Right. That's what I was waiting for.
AVGE, 21% for 2025.
Which is pretty good, because I think our all equity portfolio made something similar with a lot more work and a lot more time to it. That's what I'm getting at. But yeah, go ahead.
AVGV,
yeah,
23.5%.
Fascinating.
It is fascinating. Yeah. I'm not saying one is better. You should never look at returns and go, this fund's better than this fund based on that, because there are too many factors that go into those. Factors, literally. But I find it fascinating if you believe, like many of the academics believe based on their research, that value has shown a propensity in the past to outperform growth and small has shown a propensity to outperform large, then AVGV should do better, but you got to. Okay, sometimes it won't.
Could get it. We could drill down here about okay, what is a value stock, and how do you view value? I view value.
Yeah, that was that Jason Zweig article.
That's what I'm saying. It's not and how much profitability do you have in that, and how much
momentum,
and there's a lot of other factors.
My gosh, there are so many factors now. I liked it when it was just kind of value and small.
Well, I think it was exposure to stocks first, and then
stocks value. Yeah. Just overall risk, value, and small. Yeah.
But the thing is, again, here that you have to decide as an investor is, what do you believe? I mean, you have to make a call, right? I mean, because you could just go VT, Vanguard's total market,
no tilt at all,
and say, well, that's been pretty good. It's been pretty good. That's right. So those are decisions everybody has to make on their own.
Ooh, let's look at VT just out of curiosity and compare
just
it.
For 24 and 25, just out of curiosity. I will say,
I bet it won in 24 and lost in 25.
I think that's what I was going to say. Yeah, because you did have, especially in the international side, small value had a huge year. I think I mentioned it was up over 40-some%.
Oh, we would both be wrong.
Oh, okay.
VT outperformed both in 2024 at 16.5%.
Yeah.
And slightly underperformed the value at Avantis at 22.4%.
For 2025.
For 2025.
Yeah. Again,
growth is still winning.
Do I think you could go wrong with any of these?
Probably not. They're well diversified.
They're probably okay. They're well diversified. They're low cost. So
855-935-8255. 10 digits you need to memorize. And if it's hard for you to memorize them, 855-935-TALK. Talk. That's letters, too. Or you can send us questions if you have them at talkingrealmoney.com on the contact form.
What did the guy write this week? Tom's War on Trees?
Tom's War on Trees. Yeah, I'd like to participate in Tom's War on Trees. I don't like those trees either. They block out the sun that happens once a year.
Exactly. We had a little yesterday, and it was hard to see. Brian wrote in from Corvallis, Oregon. He said, hi, Tom and Don, love the show. Very entertaining, great information. Quick question on the Fidelity Zero index funds. They've started index funds with a 0%. He calls it an admin fee. It's actually an expense ratio. How can they do that? What's the catch? Or do you think they're using these funds as a loss leader to get new clients?
There you
go.
Do
you think the deal will go away after a year? I'm always leery of deals that are too good to be true. Taken from their site, Fidelity now offers the Fidelity Zero Large Cap Index, the Extended Market Index, the Zero Market Index, Total Market, the Zero International Total, et cetera, to retail investors who purchase their shares through the Fidelity brokerage accounts. You got to have your money at Fidelity to get that deal.
Yep.
So that's a little bit of not a huge catch, but
he broke the code. It's a loss leader.
Yep.
It's a loss leader. It's a tool to get you in the door. Once they have you, they're going to try to convince you to do some other things, like hire them to to give you advice. And the other trick to these zero funds is that they are not actually the index. They are index emulators. They cost less to run because they don't do the whole darned index, but it's a loss leader. That's what it is.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
You, yes, you. I mean you. No, I'm talking to you. You can call us at 855-935-TALK anytime. Well, on Saturdays between 3 and 5 Eastern or noon and 2 Pacific on Northwest News Radio. 855-935-8255 is that phone number. And I really think that I'm going to have to sit down one day and create a nice sounder, a nice sting intro for Jason from Sammamish.
Oh, Jason. Did you read Jason Zweig's article yesterday in the Wall Street Journal?
I missed that one. I'm sorry.
Oh, he had your favorite company in there, which some people claim is a value stock, which almost caused my heart to end. Excuse me?
Oh, it's absolutely a value stock. If you're looking forward to,
you're setting the man up.
Come on, I want to hear how. How is that in the world? What is it? It trades like 100,000 times per earnings or something. Come on.
You have to look ahead to all the total addressable market for robotics, for SpaceX. All the different ventures they're in. Come on,
wait,
guys.
whoa! You said SpaceX. That's a whole different company. That's not Tesla.
Well,
that's going to go public on its own this year.
That's true, but you don't think that Tesla's going to trade, higher in sympathy with SpaceX?
I'll tell you why I don't, because every number about Tesla's actual performance, like the number of cars they're selling, is going down. Mm-hmm. So, no, I would not expect that.
That's because we've got big YD. They're looming.
Exactly.
Robotaxi. Tesla's going to win the robotaxi wars. We know that.
We know that.
Come on. That's confidence.
Wow.
All right. Well, the great
we,
debate
at
can
least
begin.
we hedge and say we think or we believe.
Yeah,
you actually come right out and say, I know.
Yeah. Good for you, man. Love the confidence.
I've got to live up to my name.
Okay. All right. Tesla Bull.
All right. What's your question today?
He doesn't have one.
He's
here for his segment of the show.
I do.
I see. This is the Jason moment.
I have to say Happy New Year. We did miss you last week, so I'm glad to have you back.
Thanks.
Okay.
I'll say thank you to that. I appreciate it. So, yeah.
Of course. So my question is, I have two. First one is, what are your thoughts on? I know you guys have been talking a lot about AVGE recently, which is, I haven't been too familiar with the Avantis funds prior to your mentioning them, but I really like VTI. As you know, it's more U.S. based. Mm-hmm. But what are your thoughts on something like a VTI? 70%, 30% AVGV. What would your thoughts be on something like that? Then I have another question.
Okay.
I think it'd be fine. Nothing wrong with that. I mean, you're hedging a little bit because you're saying on one hand, I got most of my money in basically an index and then 30% is, kind of more small, more value.
More value to it.
That's okay. Yeah.
I just didn't know if you thought that 70-30 was good or if you like more 60-40 like on the growth side or.
Yeah.
Oh, I see. That's making a bet. If I was making a bet, I'd be more on the value side than the growth side.
Yeah,
because history shows it's been better. Especially if Tesla's a value stock. We're all about that.
Yeah, I got to go back to that for a second. Hold on. Tesla's PE right now is 235.
God's sake.
Apple's PE is 35.
What is Amazon's? I mean, come on.
So if this is a value stock, Apple's a super value stock.
Hey, Tesla is a value stock when you compare it to Palantir. Come on.
Wow.
Oh,
yeah, okay. There we go. Thank you.
It's all your reference point. That's what matters. It's your reference point. All right, you have another question. Go ahead.
Yeah, I'll be quick. So I also was reading about one more for like my mom, to suggest for my mother for more of a stable fund is SPYM. What are your thoughts about SPYM?
SPYM.
Don't know it. I got to look it up.
Oh, that's
the stars.
That's an S&P 500.
Yeah,
SPY is
major differences between some.
Oh yeah.
Yeah, go ahead.
Pardon me. Yeah, go ahead. No,
I'm just looking at what the difference in the portfolios is because it looks to me like it's the it is. It's the
S&P 500. Yeah.
What's the M stand for?
Okay.
I don't know that.
I don't know.
I'm not sure.
Because SPY is the S&P 500.
Yeah, this is SPYM. Maybe it means
they just
less
felt
money.
They had letter envy or something.
I mean, it's two basis points.
Good Lord.
Yeah, I think that was what attracted me to it. Was really
basis points. Well, and it gives you a whole lot of that. It gives you a whole lot of some of your favorite stocks there.
You got more Tesla. You got a
more
little NVIDIA in
Palantir,
there.
you got more
Palantir. All that good stuff, man. Pile it in there.
Yeah. All right. Well, that was all I had for you guys. Tesla's going to be the company of the decade for the 2030.
Sure it is. Yeah, I'm still waiting for that.
The 2030. I'm not going to live that long, so it's not going to matter.
When will true, real FSD be here? When is that?
Like any moment, next week.
We're working on it.
Okay. Yeah, I'm going to be next.
Jason,
Next month,
aside,
I'm going to be taking a Waymo self-driving taxi here in Orlando, and I'll let you know how that works out.
All kidding aside, thank you for listening, and thank you for calling us. We appreciate you engaging. It always is, and it means a lot. So thank you.
And you've got a sense of humor, as do we, apparently.
But 235
855-935-TALK.
I'm getting too old for this.
Yeah, you've been too old for a while.
That's true.
I'm older than you, but you're older than me.
I think so, in terms of years and miles, yeah.
No, just miles. The way you think. You think older.
Yeah, that's true.
Well, plus you got all those miles on the soccer field. I put in all those miles at my desk in front of a microphone.
And it probably lasts longer.
Yeah, I last a lot longer. So give us a call, 855-935-TALK, 855-935-8255, or you can send your questions in at talkingrealmoney.com. Should I? Yeah, we can do it. I can bring him over the break. Let's go to Albuquerque. Casey, welcome to the show.
Hey, thanks for having me, guys. I've been listening to you for a while, and I just I feel like I'm learning a lot. So thank you.
You're welcome.
I was calling because I have a Fidelity large cap professionally managed portfolio. I kind of opened it up for my daughters so I could pass it on to them, but I'm thinking that I want to switch it up and go to something that's more diversified.
Okay.
And
I tell you what, hang on with us a minute, because you said it's a professionally managed. So let's get into the details of that portfolio and see what you might do.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number again is 855-935-8255. Every Saturday, give us a call, just like Casey did from Albuquerque. And Casey has a portfolio that is a large cap Fidelity portfolio managed by a professional there. So you're using one of their advisors, is that correct, Casey?
No, well, it's called Fidelity Managed Portfolio. I just opened it up online, and it's described as a U.S. large cap strategy which invests in an actively managed portfolio of domestic growth and value stocks.
Yeah. So, I mean, there's a couple of things here to unpack. Number one, if I wanted to just buy large cap in the United States, I'd buy it. I think we just said SPY is 2 basis points. It'd be a no-brainer to me. It's probably going to be a little more spread out. I'm betting that the one you're in is more concentrated because somebody there's making bets about which companies are going to be better than others. That's number one. Number two is exactly the right point, Casey. You want everybody who's invested in stocks to own smaller companies and more value companies and international companies and emerging markets and all those other places that you're not getting exposure to in a managed S&P 500 fund.
Yes. And so I heard you guys talk about AVGE and AVGV, and so I'm probably gonna, if I can get this money out of Fidelity, I'll probably buy Avantis funds with that money.
Yeah, and I'm trying to find the fee,
which I'm sure they bury because. Go ahead.
It's a special account.
Like 25 basis points.
Okay, I was trying to find the fee. This is a portfolio. It's a large cap, actively managed portfolio that has about 200 stocks in that portfolio. So they're trying to pick the best. And the evidence all shows, and it's been showing this for decades, for as long as we've been looking at it. The evidence shows that over longer periods of time, active management is almost always detrimental to you. It's
In
almost
other words,
always
you're going to
detrimental.
Underperforming, just owning the market. And by the way, with AVGE, I don't know about AVGE. Oh, no, I do know about AVGE.
There's E and there's V.
AVGE, you own about, I think it's 9,000 companies. So instead of owning 200, you're far more diversified. I'd prefer that. And I think you should for your children as well.
Yeah, and your costs are going to be very similar.
Yeah,
with an AVG, I think it's 23 basis points, and you're paying 25.
Yeah.
So it's almost exactly the same, but we think you're going to get a lot more because you're going to get this massive amount of diversification with nobody trying to pick. There's the difference. Avantis uses mathematics. They use an algorithm to tell them these stocks fit, these stocks don't. You don't have anybody trying to say, well, I think based on the parking lot that this one's going to do better in the future. You don't have any of that. So I think it's a smart move on your part. We agree.
Yep.
Gotcha. And another thing on top of that, when I call in to Fidelity to kind of wrangle myself from this account, they'll probably try to talk me out of it. What should I say?
No,
Tell them Don and Tom sent you.
Tell them that you want to move everything into AVGE or AVGV or whatever it is that you decide on, and they'll still get business from you, just not as much.
Oh, okay. So they'll still get a cut.
Yeah, you can keep the Fidelity account. You're just going to move the money from this portfolio to an ETF.
Okay.
And by the way,
are you
double check on that 25 basis points because I just did some checking, and
sounds cheap to me.
Yeah, it's I'm finding some people talking about 70 basis points.
That sounds more likely. By the way, if what we just suggested didn't work, I'd tell them in Albuquerque I'm pals with Walt Weiss and see if that maybe changes their mind a little bit.
White, not Weiss.
I know. I'm trying to play around.
You're playing around with that.
The one who knocks.
Yeah.
Exactly. There you go.
I haven't watched Pluribus yet for the newest Albuquerque show.
I know.
I got to watch it.
You guys are good for you.
Hey, Casey, thanks for the call.
Yeah.
We appreciate it. Take care. 855-935-TALK is our phone number. Now, there's a game show on that I used to watch all the time because I thought it had one of the finest game show hosts on TV, Alex Trebek.
It was one of the finest. Yeah.
Now it's got a guy I just can't listen to. I cannot watch the show.
You're going to pick on him even though he's from Seattle?
I don't care. I don't think he's a good host. He's a smart guy. I just don't think he's a very good host. Yeah. And for those of you who don't know, Jeopardy is a show where three smart people, typically very geeky, are at little podiums and they give the question to an answer. Yeah. So they give you the answer to the question and you say, what is a blank?
Blank. Yeah. Right.
And you can buzz in. Anybody can buzz in. This is from a recent episode of Jeopardy, and let's see if you're smarter than the Jeopardy contestants.
Money 8. ETF stands for this kind of traded fund, for the type of marketplace at which they can be bought and sold. Cameron.
What is electronic?
No. Harvey or Jason? It's an exchange-traded fund.
The first guy said an electronically traded fund. And then he goes, nope, you were wrong. Anybody else? Because now anybody else, it's open to everybody. You got three people. How many knew it was an exchange-traded fund?
And here's something to consider. Last year, 2025, 1.5 trillion with a T dollars went into exchange-traded funds. So there's a lot of people that do know about them.
I bet everybody listening to us right now is smarter than a Jeopardy player, at least on that question. 855-935-TALK. Give us a call every Saturday, and we'll be back after we do this thing.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
The show goes on and on and on and on, and we love answering your questions. Whether you call them into us at 855-935-TALK or send them in at talkingrealmoney.com. Do you have a question? You look like you have paper there sitting in front of you.
I do. Sarah from Cave Creek, Arizona. That'll be the next vacation, by the way. Hello, Don and Tom. Your do-it-yourself portfolios are great, especially the two funds. So why choose AVGE over VT Wax or vice versa? Or maybe it doesn't matter. They're both great.
Yeah. Okay. VT or VT Wax is just the total market. It's
It is.
the index. It emulates what the market, the total U.S. stock market, looks like at any given moment. So
VT Wax global, or is that just U.S.?
I'm sorry, the global. It is global. VT Wax is global. VT is also global. The entire global market, I meant to say, but I'm still virus brain.
That's why I'm here.
Thank you for helping me out.
No problem.
The Avantis funds, the Avantis ETFs like AVGE or AVGV now, just to make things more confusing.
Oh boy, yeah, of course.
Give you they give you the same stocks basically. They just give them to you in different amounts.
And they add some other things in that are going to influence the returns. Again, we don't know the future.
Pretty much it's the same kind of portfolio.
Yeah, the past would suggest you make a little bit more with some of those other factors, if you will, but no promise there.
So they tilt you a little bit to
choose,
value, and they tilt you a little bit to small. And so all things being equal, given our knowledge, if you had to choose.
Where we are today, I would choose AVGE.
Yeah.
Yeah, or AVGV. God's sakes. I tell you, one other thing I'd choose is I'd choose to see Tom and Don at retirement. Great ads, by the way. First time I heard them.
Oh, that's the first time you heard them.
They were really good, very creative. But you make a good point in the ads. There's pretty smart people coming. I mean, you got Christine Benz from Morningstar, Joel Saul Seahigh, you got Dimensional, you got Vanguard, you got all Medicare, et cetera. I mean, we've done this. This will be what did I say?
12th.
12th. No, I think.
No,
is 12th in Bellevue plus 2 more.
Oh, plus 2 more, but 12th year really, because we did multiples in other years. Yeah.
So and as the ad mentioned, we've sold that every year. Plus, if you get a ticket now, you get a cheaper, I think, an early bird special.
I have no idea. I think it's on couple tickets.
Less expensive.
I think it's on couple tickets.
Okay, so you're going to want to do that, and you're going to want to do it soon. So go to Retire Meet. It's Saturday, March 7th.
You're likely to come with somebody anyway.
Yeah, exactly. So March 7th, Saturday, it's relatively inexpensive. It does include breakfast and lunch if you don't get anything else out of it, but I think you will.
Actually,
Paul Merriman,
given today's prices at restaurants, it's just for the food, it's a good deal. I think it's $35 for a couple. Where can you go and get a decent breakfast and lunch for $35 for two people?
I think it's more than that, but I could be wrong.
No, I think it's 35 for two. I'm pretty sure. Maybe it's 50, but it's still
all right. 35, 50, going up.
I don't.
But join us March 7th in Bellevue, Maidenbauer Center. It's a great event. Done this, as I said, this is the 12th one. Sold it out every year, with or without Jim Zorn. So take it.
Oh, I'm sorry. You're right. 55. It's 35 for a person. 55 for a couple.
Okay. Yeah, but still breakfast and lunch.
Breakfast and lunch. Deal. Yeah, I mean, I just took Debbie to.
This is the only time of year I can guarantee we get Don out of his, little.
Yeah, I'm coming out. I haven't booked my ticket yet, but I'm coming.
Yeah.
I took Debbie to the Hollywood Brown Derby at Disney Hollywood Studios yesterday for lunch. Just went for lunch. $100 for two.
How much?
$100. We got to go.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.